If you've been feeling that invisible pinch, the one where rising costs just seem to slowly eat away at your purchasing power, listen, you absolutely aren't alone. Today, we're diving into a really fascinating explainer breaking down a framework from Brian the CPA. It's called the Opportunity Bucket Strategy. All right, let's jump straight into Section 1, the hidden tax problem and the 60-40 trap. Now, this is where Brian really aggressively challenges conventional Wall Street wisdom. He argues that the standard 60-40 portfolio, 60% stocks, 40% bonds, is actually a trap in today's high inflation environment. He calls our current macroeconomic situation economic theater. Historically, bonds were supposed to be the ultimate safety net, right? They'd zig when equities zagged. But the surprising and honestly often painful reality of stagflation or high currency debasement is that bonds and equities can actually crash together. When the currency itself is losing its purchasing power, locking your capital into fixed income yields that pay out less than the real rate of inflation, well, that's not diversification. That's just locking in a guaranteed loss. All while this economic theater projects an illusion of safety. Which brings us to Section 2, the Opportunity Bucket Strategy. So how do we counter this trap? Brian proposes a very specific, mathematically calibrated allocation target, exactly 20%. And this isn't just a number picked out of thin air. In the world of portfolio construction, a tiny 5% allocation, that's probably too small to actually save your purchasing power if fiat currency really takes a dive. But on the flip side, throwing 50 or 60% into highly volatile commodities introduces way too much concentration risk. 20% is that Goldilocks counterweight. It's large enough to actually move the needle and offset the depreciation of your other assets if the fiat system struggles, but measured enough to keep you comfortably in the game if this whole macroeconomic thesis takes years to play out. This approach is really all about ring-fencing your capital. You are consciously carving out a strict protection layer within your broader investments. That 20% slice is your opportunity bucket. It's a distinct defensive posture separated from your primary growth engines. The remaining 80%, that continues to be the rest of your portfolio, whether that's your businesses, real estate, or traditional equities. And the psychological benefit of isolating this 20% is actually huge. It allows you to view this specific chunk of capital not as a vehicle for chasing quick, flashy returns, but as a dedicated, impenetrable wall against monetary debasement. It's fascinating to think about this bucket not merely as an investment choice, but really as a highly specialized insurance policy. Think about it. A standard insurance policy protects your house if it catches fire, right? Well, the opportunity bucket is an insurance policy that actually pays out when the currency itself gets sick. It is a strategic allocation into hard commodities engineered to act inversely to the health of the dollar. So when the dollars in your wallet suddenly buy less at the grocery store or the gas pump, the scarce, unprintable assets in this bucket are structurally positioned to command a higher premium, effectively rebalancing your real-world purchasing power. Okay, let's move on to Section 3, Unprintable Hard Assets Explained. So, what exactly goes into this bucket? Brian outlines 5 specific, high-conviction plays that make up this protection layer, and the thesis for each goes way beyond surface-level investing. First up is silver. This is a totally unique asset that straddles the line between historical money and an irreplaceable industrial component for things like solar panels. Then there's uranium, backed by the undeniable math of global energy demands. As the world scrambles for clean, base-load power, nuclear energy is facing a massive supply deficit. Next is Bitcoin, representing absolute mathematical scarcity. It's the only liquid asset in human history where a massive spike in demand physically cannot trigger an increase in supply. Then we have copper, which is essentially the great bottleneck of the future. You literally cannot build the next generation global power grid without mountains of it. And finally, gold. It remains the ultimate timeless Tier 1 reserve asset, which, by the way, is exactly why central banks worldwide are quietly hoarding it at record paces right now. Now, Brian makes a really critical distinction here. This is smart investing, not wild gambling. When people hear words like Bitcoin or uranium, they often immediately picture rampant, volatile speculation. But the core philosophy here is heavily defensive. The goal is to structurally capture the upside of inflation. You can kind of think of these hard assets as financial sponges. Because their supply is rigid, constrained by the literal laws of physics or mathematics, they naturally absorb the excess liquidity that central banks pump into the system. So while traditional cash savings slowly evaporate under that hidden tax, these assets soak up the new currency, reflecting its devaluation through much higher nominal prices. Let's wrap things up with Section 4, Building Your Financial Fortress. This leaves us with the ultimate question. How do you actually protect your future from inflation? It is, without a doubt, the most pressing dilemma for anyone trying to build lasting wealth today. And it forces a pretty uncomfortable realization. Simply putting your head down, working hard, and hoarding cash in a traditional bank account just doesn't cut it anymore. The macroeconomic ground is shifting right underneath us. To preserve the time and energy you've already sacrificed, you have to actively build a fortress around your wealth to stop inflation from silently draining away your future potential. So the ultimate takeaway from Brian's framework is to proactively use this opportunity bucket to stay ahead of a system that is inherently designed to dilute your purchasing power. Brian actually has a community called Hidden Tax that focuses entirely on keeping this underlying math in the investor's favor, constantly tracking how global liquidity flows into these hard assets. It fundamentally changes how we measure our own net worth. I want you to look closely at your own portfolio today. Ask yourself, are you holding the unprintable wealth of the future, or just paper that they can print for free? Keep learning, and we'll catch you in the next explainer.